A dam is the closest thing to a legal money printer that humans have ever built. Think about what you're actually buying. The fuel is free. It falls out of the sky for free forever, and nobody can embargo it, tariff it, or shut off the pipeline. The machine that turns that free fuel into electricity was designed to run for 100 years, and some of the turbines spinning right now were installed when your grandparents were children. The marginal cost of producing one more unit of power is, functionally, zero. Now here's the part that should make you angry. We've basically stopped building them. In the United States, more dams are being torn out every year than are going up. Billions of dollars in concrete that took a generation to pour, and we're paying demolition crews to take it back out. Meanwhile, the same investors who won't touch a dam are dumping money into power plants that will be scrap metal in 20 years and need to be fed something expensive every single day just to stay alive. So which is it? Is a dam the greatest asset in the history of infrastructure, or is it a trap dressed up as a fortress? Because here's what nobody tells you when they show you the pretty photo of the spillway. That free fuel comes attached to the most brutal cost structure in energy. The upfront bill can eat a decade of your life before you sell a single kilowatt hour. The regulatory paperwork to keep operating can cost more than the dam originally cost to build. And the day you buy it, you inherit every ton of sediment, every fish that can't swim upstream, every lawsuit from every town downstream, and one liability so catastrophic that most insurers simply refuse to write the policy. That's the trade. Free fuel forever, in exchange for a risk that never, ever goes away. And yet the people who understand this trade best aren't running away from it. They're quietly buying. Pension funds, sovereign wealth funds. The most patient money on earth is accumulating 100-year-old concrete while everyone else chases the next big thing. They know something. So let's actually run the numbers. What does a dam cost? What does it earn? Who really owns them? And why is the boringest asset in the world suddenly the one everybody wants? Let's start with what you're actually buying, because it isn't the concrete. The concrete is not the asset. The asset is a height difference. That's it. That's the whole business. Water sits at one elevation. You let it fall to a lower elevation, and on the way down, it turns a wheel. Multiply how far it falls by how much of it falls every second, and you have your revenue. Everything else, the spillway, the transmission lines, the visitor center with the gift shop, all of it is support staff for that one number. Which leads to the first thing almost nobody understands about this business. Two dams that look identical can be completely different companies. A wall in a canyon with a 200-meter drop and a trickle of water can out-earn a wall across a wide river carrying enormous flow with a 10-meter drop. Height is worth more than volume. So when you hear someone say, big dam, that tells you nothing about the money. Some of the ugliest, smallest, least photogenic installations in the world are quietly printing cash, and some of the monuments you've seen on postcards are, financially speaking, pretty mediocre. But there's a second thing going on here, and it's the one that matters most, so stay with me. A dam isn't just a generator, it's a generator with a battery attached. The reservoir is stored energy. Every cubic meter of water sitting behind that wall is electricity you haven't sold yet. And here's the crucial part. Electricity you get to choose when to sell. Think about what that actually means. A solar farm has no choice at all. The sun comes up, it produces, and it sells into whatever price the market happens to be offering at that exact second, alongside every other solar farm doing the identical thing at the identical moment. It's a price taker in the purest, most helpless sense of the phrase. Wind is the same. Produce or don't produce. There's no wait. A dam waits. A dam sits there at 3 in the morning when power is nearly worthless, makes nothing, holds its water. And then at 6 in the evening, when everyone gets home and turns on everything they own, and the grid is screaming and the price has gone up by a factor of 10, it opens the gate. You're not selling electricity, you're selling timing. And timing, in a grid full of machines that can't control their own timing, is getting more valuable every year. Hold on to that, because it's the whole ending of this video. Okay, the pitch is beautiful. Now let's look at the invoice, because this is where the dream goes to die for about 95% of everybody who has ever tried it. A dam is almost pure capital cost. Effectively, every rupee, dollar, or euro you will ever spend, you spend before you earn a single cent. And it isn't just the wall. You're paying for site studies, geology, environmental impact assessments, fish ladders, the transmission line that connects you to a grid which might be 100 kilometers away, the road you had to build to get the trucks in, the town you had to relocate, the archaeology you found underneath the town, and the lawyers you needed for every single one of those line items. The wall itself might be less than half the bill. And then there's the thing that eats people alive: time. You are not opening in 18 months. Between the first survey and the first kilowatt hour, you're looking at the better part of a decade, often considerably more. And the entire time, you are paying interest on money that is producing absolutely nothing. Sit with that for a second, because this is the actual mechanism that killed the dam building era, and it has almost nothing to do with environmentalists. Compound interest on a 10-year construction loan can add a cost roughly equivalent to the physical structure itself. You can build the dam perfectly, on budget, exactly to spec, and the finance charges alone can turn it into a bad investment. And large infrastructure has a famously ugly relationship with budgets. The research on mega projects is genuinely brutal here. Overruns aren't the exception. They're the base rate, and hydro is one of the worst offenders in the whole category. The optimistic projection was never a projection. It was a sales document. So here's the real reason we stopped building. It's not that dams got worse. It's that money got impatient. A gas plant goes up in 2 or 3 years, solar in months. The modern investor wants capital back inside a fund cycle, and a fund cycle is 10 years, and a dam doesn't even say hello in 10 years. The returns aren't bad. The returns just arrive after the people who approved them have retired. Now flip the thing over, because if you survive the bill, you inherit the single best cost structure in the entire energy industry. Here's the fuel budget for a hydroelectric dam. Nothing. There is no fuel budget. It rained. Here's the staffing. A large gas plant needs a real workforce showing up every day. A large dam can be run by a crew you could fit in a minibus, and increasingly by people who aren't even standing on site. Here's maintenance: grease, bearings, the occasional turbine rebuild, and a great deal of inspection. Real money? Sure. A rounding error next to what a coal plant spends just on coal before breakfast. And then there's the part that breaks people's brains. The asset doesn't really die. A gas turbine has a lifespan. Solar panels degrade every year, guaranteed, contractually. And in 25 or 30 years, you're buying the whole field again. Wind turbines have a fatigue life. The steel gets tired. But concrete sitting in compression, in cool water, doing nothing except existing? That's basically geology. There are dams earning revenue right now that were built before anyone invented the transistor. And when the turbines finally wear out, you don't rebuild the dam. You swap the turbines and carry on. And the new ones are more efficient than the ones you pulled out. The asset gets better with age. So follow the money across time. Decade 1 is a catastrophic outflow, zero income, terrifying debt. Decades 2 and 3, you're paying down that debt, revenue is arriving, everyone is still nervous. And then decade 4 shows up and the debt is gone and the water is still falling. At that moment, the thing turns into something that barely exists anywhere else in finance. A machine with almost no operating cost, no fuel exposure, no meaningful obsolescence risk, and revenue that rises with the price of electricity, which means it rises with inflation, automatically, forever, without you doing anything at all. Hoover Dam is the cleanest example anybody's got, financed with federal debt in the middle of the Depression. That construction debt was paid off decades ago, and the thing didn't stop. It just kept going, selling power into a market that has repriced upward for 50 years, running on fuel that has never once sent an invoice. That isn't an investment. That's an inheritance. So why isn't everyone doing this? Because so far I've been describing the asset. Let me describe the liabilities. And they are genuinely nightmarish. Start with the big one. You don't own the water. Read that again. You own the wall. Somebody else owns the river. Usually the state, sometimes a treaty, sometimes a court, and very often all three fighting each other. Your right to use that water is a license, and licenses have terms, and terms expire. And when renewal comes around, you are not negotiating with the world that built your dam. You're negotiating with today's world, today's environmental standards, today's tribal rights litigation, today's politics, and the price of renewal is whatever they decide it is. Fish passage, minimum flows you have to release whether or not you generate anything from them, recreation access, sediment management plans, Every one of those is a permanent tax on your revenue, and you cannot refuse, because your alternative to accepting the terms is owning a wall that isn't allowed to make electricity. There is no leverage on your side of that table. None at all. Which, by the way, answers the question I opened with. All those dams coming down? It's usually not hatred of dams. It's arithmetic. A small, old, marginal dam comes up for relicensing. The regulator says you need a fish ladder, and the fish ladder costs more than the dam earns in a decade. So the owner does the only rational thing available and walks away. The removal isn't ideology, it's a spreadsheet. Then there's the weather, and the weather doesn't owe you a living. Your revenue is rainfall. Rainfall is a probability distribution, and lately it's a probability distribution nobody trusts. A drought year isn't a soft quarter. It's a structural collapse in output that you cannot fix by spending money. There's no supplier to call. You cannot order more river. Every other generator on Earth can buy its way out of a supply problem. You just sit there and watch. And then there's the one almost nobody talks about, which is the one that actually gets you. Sediment. Rivers carry dirt. Your reservoir stops the water, so the dirt settles out and stays. Every single year, your battery gets a little smaller. Forever. Reservoirs around the world are losing a meaningful slice of their storage capacity annually to silt, and there is no cheap fix. Dredging is brutally expensive. Flushing wastes water and enrages everyone downstream. You bought a 100-year asset with an hourglass buried inside it, and it's filling right now while you sit here watching this. And then the last one. The one nobody wants to say out loud. A dam is the only power plant whose failure mode is a wave, not an outage, not a fine, a wall of water arriving at a town in the middle of the night. It's one of the very few industrial risks where the worst case is measured in mass casualties, and it means you are never ever finished with this asset. The inspections don't stop. The monitoring doesn't stop. And the moment a crack shows up in a spillway, you might spend more on the repair than a new plant would have cost, while evacuating 100,000 people who will be your legal adversaries for the next 15 years. Insurers understand exactly what this is, which is why the deep tail of that risk tends to end up where all uninsurable risk ends up. On the public or on the owner, and God help the owner. So there's your trap. Free fuel, but you don't own the river. You can't control the weather. Your reservoir is silting up as we speak. Your license is up for renegotiation with people who don't especially like you. And if you're wrong, people die. Still want one? Because somebody does. A lot of somebodies, with enormous amounts of money. And here's the twist that reframes this entire video. The people buying dams right now are not buying them for the reason the dams were built. Dams were built to produce energy. The new buyers aren't interested in energy. Energy is cheap and getting cheaper. Solar has seen to that. In some markets, the midday price now goes to zero and occasionally negative, which means you get paid to consume it. So if energy is nearly free, what's scarce? Control. The grid is now full of generators that produce whenever they feel like it and stop whenever they feel like it, and not one of them can be told what to do. What that grid is desperate for is anything that can be dispatched. Anything you can point at and say, give me power right now for 4 hours on command. And it turns out we already built the best machine on Earth for that, decades ago, completely by accident. A reservoir is the cheapest large-scale energy storage humans have ever constructed, and unlike a battery, it doesn't degrade, it doesn't catch fire, and it doesn't need replacing in 15 years. Then there's the version that takes it one step further. Pumped storage. 2 reservoirs, one high, one low. When power is free or negative at noon, you use it to pump water uphill. When power is expensive at 7 in the evening, you let it fall back down. Yes, you lose energy on the round trip. That loss is irrelevant when you're buying at zero and selling at the peak. That's not a power plant. That's a trading desk with a lake attached. And every solar farm built anywhere near you makes your lake more valuable because it pushes the midday price down and makes the evening spike sharper. Your competitors are working for you, and they don't even know it. So the dam changed jobs. It used to sell electricity. Now it sells the ability to move electricity through time. And nobody has worked out how to build a new one of those cheaply, which means the ones that already exist are, in the most literal sense of the word, irreplaceable. So who's holding all this? Overwhelmingly, still governments and utilities. Most of the world's big hydro was built by states because states were the only institutions patient enough and coercive enough to do it. You need to move towns, and only a government can move a town. But the buyers at the margin, the ones actually writing checks today, are a very specific and very telling kind of money. Pension funds, insurers, sovereign wealth funds, infrastructure funds with 30-year horizons. And once you understand what those institutions actually need, the whole thing snaps into focus. A pension fund has a problem that is the exact mirror image of a dam. It owes money to people who will still be alive in 50 years. Its liabilities are enormous, distant, and they rise with inflation. What it needs isn't growth. What it needs is a boring, indestructible, inflation-linked cash flow that will still be arriving long after everybody currently in the room is dead. Now look at the dam again. Boring, indestructible, inflation-linked. Cash flow arriving after everyone in the room is dead. It's not an investment. It's a liability match. And that's the answer to the puzzle I started with. The venture guy and the pension fund look at the same wall of concrete and see two completely different objects because the discount rate they apply is different, and a discount rate is really just a mathematical statement about how much you care about the future. Standard finance is structurally incapable of valuing a dam properly. Run a 100-year asset through a conventional model, and everything past about year 30 vanishes into rounding. The math deletes the best part. It has to. That's literally what discounting is for. So the model looks at 70 years of nearly free money and reports back that it's worth approximately nothing, which means the price can be systematically, structurally wrong. Not because anyone's stupid, but because the tool that everybody uses has a blind spot shaped exactly like a dam, and a small group of very patient institutions have quietly noticed. So, money printer or trap? Here's my honest answer, and it's going to annoy both camps. It's the same object. The only variable is you. A dam is a trap for anyone who needs their money back within 10 years. It will destroy you. The construction risk will destroy you. The interest will destroy you. The license renewal will destroy you. The first drought will destroy you. And a dam is a money printer for anyone who doesn't need the money back at all. Same wall, same river, same turbines. Opposite outcome. We didn't stop building dams because we ran out of rivers. We stopped because we ran out of patience. We built an entire financial system that is physically unable to see past about 15 years, and then acted surprised when it stopped producing 100-year things. Every dam still standing was built by a civilization that thought about time differently than we do. And right now, quietly, that inheritance is being handed from the people who built it to the people who can still afford to wait. The most valuable thing in this business was never the concrete. It was never even the water. It was the time horizon. And that's the one thing we've genuinely stopped making.